Good morning, I'm Maiki Oreta and you're watching Business 360, where we break down the numbers, connect the dots, and give you the developments and the insights you need to navigate, adapt, and lead. Let's dive right in. Billions in duties at risk. The Philippines could lose 3 to 6 billion pesos a year under a zero-tariff deal with the United States. Finance Secretary Ralph Recto says that the agreement, still not final, covers wheat, cars, medicine, and more. E-gaming stocks rally. Investors cheer as President Marcos stays silent on a proposed online gambling ban in his SONA. DigiPlus jumps double digits on hopes of regulatory clarity. And later in the show, Security Bank's chief economist, Angelo joins us live. We'll break down what the president said and didn't say in his fourth SONA and what it means for interest rates, growth, and investor confidence. First, Wall Street closes in the red as investors digest disappointing earnings and rising tensions with China. United Health tumbled over 7% after issuing weak guidance, while Boeing fell more than 4% on a rough quarter. Adding to the volatility, U.S. Treasury Secretary Scott Bessent threatened China with secondary sanctions over its continued purchase of Russian oil. All this ahead of the Fed's rate decision on Wednesday, with markets hungry for hints on possible cuts.
So markets have been hitting all-time highs over the course of the last, several weeks. A little bit of a pullback here on some weak earnings numbers, from some fairly, significant companies. United Healthcare reinstated guidance, but it was below what folks were expecting. So that's weighing on the Dow for sure. And so, puts and takes. It's healthy to have some red days on the screen, as long as they're not too red, but to have some red days to offset some of the green days. And again, I think as we look forward for the week, the next couple of days in terms of earnings of some of the Mag 7, getting some inflation data, getting some jobs data, that'll take us right into the first week of August, where half of Wall Street will be on vacation anyway. So we'll pick it up in the middle of the month.
The Dow Jones Industrial Average slipped 0.5%, the S&P 500 dropped 0.3%, and the Nasdaq closed lower by 0.4%. Over in Europe, a different story. London's FTSE 100 rose 0.6%. Germany's DAX climbed over 1%, and France's CAC 40 higher by 0.7%. Here at home, the Bangko Sentral ng Pilipinas is signaling a possible rate cut next month. This comes as market uncertainty from the recent U.S. tariff hikes begins to ease and domestic inflation remains below target. BSP Governor Eli Remolona Jr. says monetary authorities are eyeing a total of 50 basis point reduction in interest rates in the second half of 2025. He adds that the cuts will likely be delivered across two separate monetary board meetings. The bigger picture: with inflation under control, the central bank now has room to ease policy to support growth. But with the interest rate gap between the U.S. and the Philippines now razor thin, any cuts could increase pressure on the peso and shake investor confidence if not timed properly. As the central bank moves to loosen monetary policy, the fiscal side faces its own trade-offs. The Philippines stands to lose an estimated 3 to 6 billion pesos in annual revenues due to zero tariffs on select U.S. commodities. That's according to Finance Secretary Ralph Recto, who cites preliminary estimates. Speaking at the post-SONA briefing, Recto says the potential revenue hit comes from removing duties on imports like automobiles, wheat, pharmaceuticals, and soybeans. He clarifies that the trade deal is still under negotiation and not yet final. Even with the U.S. imposing a 19% tariff on Philippine exports, Recto insists that the overall agreement remains favorable. He argues that because the Philippines already has one of the lowest global tariffs, only a small slice of exports will be affected. With global trade conditions shifting and domestic growth still fragile, every policy move now carries wider implications. Lower tariffs may help lower consumer prices, but they also raise tough questions about revenue sustainability and national competitiveness. Online gaming stocks surge after President Ferdinand Marcos Jr. makes no mention of a proposed e-gaming ban in his State of the Nation address. The omission eases investor jitters that had weighed on the sector in the recent weeks, particularly amid growing political pressure to rein the industry in. DigiPlus Interactive Corporation's shares jumped nearly 20% to $37.75 in early trade, making it the top gainer on the Philippine Stock Exchange. Investors had been bracing for a policy shakeup or even an outright ban as lawmakers and advocacy groups pushed to crack down on online gambling over its social impact. But with no mention in the SONA, markets took it as a signal that regulatory action may not be imminent, buying time for industry players to lobby, adapt, or diversify. In a broader context, this underscores how markets read not just what's said, but what's left unsaid in a policy speech. With billions in market value at stake, the politics of silence can move prices just as much as pronouncements. The president may have sidestepped the online gambling issue in his SONA, but his economic team is already laying the groundwork for reform. With most operators still unregulated, the government is now weighing stricter rules and higher taxes to boost revenue and rein in abuse. Sujin Kim has the details.
President Marcos made no mention of online gambling in his fourth State of the Nation address, but Finance Secretary Ralph Recto clarified the administration's stance on the sidelines of the post-SONA briefings.
Ibig sabihin, pinag-aaralan pa. Hindi natapos bago yung SONA, pero clearly there will be additional regulations and possibly new revenues. But it is not a tax measure.
Recto warned that a total ban on online gambling may backfire.
My personal opinion is stronger regulation and more revenues. Because I don't think if you ban it, magpo-proliferate lang yung illegal.
Current estimates show that 60% of online gambling in the Philippines operates outside the law. Only 40% is legal.
If you ban it, 100% will become illegal. Iba naman to, iba naman yung Pogo. Yung Pogo, maliwanag, marami scam. Diba? So ito, iba naman to, no? So that's where we are. So it's a balancing act that we have to do.
One possible approach, increasing the gross gaming revenue or GGR tax from 25% to as much as 30, 35, or even 40%. But Recto cautioned that the rate must strike a balance to avoid driving operators into the underground market. Recto also addressed the potential fiscal impact of the zero-tariff deal secured in the Marcos-Trump meeting. While there is still no official computation, the initial estimate is a revenue loss of 3 to 6 billion pesos from duty-free U.S. imports, including soy, wheat, pharmaceuticals, and automobiles. President Marcos also did not address semiconductors in his SONA, despite the sector's strategic importance. Special Investment Advisor Frederick Goss said,
As of now, the U.S. is exempting it. I don't know what action they'll take. That's not for us to decide. That's for the U.S. to decide.
Both Recto and Goss stressed that the full economic impact remains unclear until the United States issues its final position. And for now, negotiations are still ongoing. Sujin Kim, Bilyonaryo News Channel.
Betting on e-games is paying off, at least for the industry. The Philippine gaming sector raked in over 214 billion pesos in the first half, even as calls to ban online gambling grow louder. PAGCOR data shows a 26% surge from last year's first half take of 171 billion pesos. E-games, including e-bingo, online casinos, sports betting, and poker, led the charge with 114.83 billion pesos, making up over half of total GGR. The boom comes as lawmakers, advocates, and even some local governments debate whether to tighten regulation or pull the plug completely. For now, the winning streak continues, but the stakes are clearly getting higher. A consumer watchdog is urging President Marcos to terminate Prime Water's contracts with local water districts, warning that poor service from private water concessionaires could jeopardize basic access in provinces across the country. The Water for the People Network says Prime Water, owned by ultra-Bilyonaryo Manny Villar, controls about 75% of local water partnerships nationwide, giving it near monopoly power outside Metro Manila. The group cites dry taps in La Union and ongoing legal battles in Bacolod as evidence of systemic failure and says the company is using courts to dodge termination clauses. In his SONA, President Marcos ordered a sweeping review of non-performing water deals, signaling to regulators that water security isn't just an infrastructure issue, but a public trust. The Philippine Chamber of Commerce and Industry is calling on government to move from rhetoric to reform, pushing for action on issues that directly affect businesses. The country's largest business groups says President Marcos's SONA failed to lay out a legislative agenda, leaving key sectors without policy direction. PCCI President Yuanina Mangyo says they were looking for moves to ease regulatory bottlenecks, streamline permitting, and modernize government services, still top pain points for entrepreneurs. Mangyo flagged chronic red tape despite the ease of doing business law, overlapping agency mandates, slow digitalization, and the high cost of compliance. Still, PCCI welcomed the president's shift toward a people and productivity-centered agenda, but stressed that delivery, not direction, will define impact. We're taking a quick break. Please stay with us as we dive deep into the numbers and the narratives that matter most to your bottom line. Let's check on how Asian markets are doing this Wednesday morning. Right now, the Nikkei 225 is trading to the downside, down by 0.1%. Hong Kong's Hang Seng Index in the red as well, lower by 0.4%. Shanghai's Composite going the other way, up by 0.5%. And Singapore's Straits Times Index in the red, lower by 0.2%. Here at home, Philippine stocks slid 0.9% yesterday, Tuesday, as investors reacted to a lack of economic direction in President Marcos's fourth State of the Nation address. The PSE index closed at 63.25 after the SONA omitted mention of key issues like online gaming policy, the 19% U.S. tariff on exports, and a roadmap for fiscal consolidation. Declines were broad-based as well. ICTSI dropped 4.1%. Bloomberry fell nearly 9%. Ayala Land lost 2%. The one bright spot, DigiPlus, surged 11% to 35.65, becoming the most actively traded stock. The absence of any SONA comment on e-gaming was seen as a green light for the sector, well, at least for now. Turnover came in at 6.86 billion pesos, with net foreign selling at 429 million pesos. Looking ahead, analysts see a cautious session today, with investors likely to remain on the sidelines while waiting for stronger signals on policy and growth. The PSEI is expected to move between 6,300 and 6,400, with any upside depending on fresh catalysts from earnings, trade talks, or macro data. Bottom line, this is still a market in wait-and-see mode until confidence returns. We can expect sideways trading. Taking a look at our market this morning, as of 10:20, the main gauge is in the red, down by 0.1% to 63.18. The broader all shares index down by about as much, down by 0.1% to 37.76. Out of the sub-indices, we're looking at a mixed picture. The financials, holding firms, property counters are leading the market's declines, while the industrial, services, and mining and oil counters are bucking the current downtrend. Total volume traded is at 185 million shares, valued at 681 million pesos. Market breadth is positive, with 66 advancers, 60 decliners, and 36 stocks unchanged. Taking a look at the currency markets, the peso opened stronger at 57.20 to the greenback, down from Tuesday's close of 57.31. The latest U.S. trade deal has Philippine officials divided, with one calling it close to nothing and another hailing it as a global win. But behind the headline 1% tariff cut is a starker 19% reality, one that could squeeze Philippine exporters, dampen investor sentiment, and even affect local prices. Sujin Kim has the details on the stakes and the split reactions from the country's economic team.
1% is 1%. That's close to nothing pumunta ka doon sa opisina ng presidente ng Estados Unidos para humingi ng 1% na tawad. Ano yun?
Acting Mayor Baste Duterte lashed out at the U.S. trade deal, criticizing the 1% reduction in tariffs secured by President Marcos following his bilateral meeting with U.S. President Donald Trump. Finance Secretary Ralph Recto admitted that the 19% tariff imposed by the U.S. will impact the Philippines' export sector.
Siyempre, tatamaan din konti exports natin initially, but as a whole, we have a better deal than many other countries.
Recto emphasized the need to view the 19% figure in context, arguing that the Philippines remains competitive under the global trade landscape.
I think pabor sa atin. I think we will benefit. I think what Trump said, which I watched on TV, is the minimum tariff globally will be 15. So tayo 19. Sa buong mundo 15. We have one of the lowest tariffs in the world if you take a look.
Recto also pointed out that many negotiating countries made significant concessions to the United States in order to avoid higher tariffs, saying they gave up everything. On the issue of zero-tariff imports, Recto clarified that only select industries were covered.
Not all imports will go down. Pinili natin, especially those that do not compete with local industries and beneficial to consumers. Halimbawa, wheat. Ayaw ba natin magmura ang pandesal? Walang taripa na yung wheat. Halimbawa, pharmaceutical, gamot. Pag binawakasan mo yung taripa, mumura ang gamot. Di pabor din sa atin yun.
For semiconductor and electronics industry President Dan Lachica, the sector's growth outlook remains flat this year, even as it accounts for 5% of global semiconductor demand.
If you're talking about the 19% tariff, reciprocal tariffs for the Philippines, and Vietnam, our biggest competitor for FDI, is at 20%. Hopefully with the Create More Act, with the improvement in the ease of doing business, which could still be improved, we'll be able to attract more investments, but it's not going to happen overnight. So we just need to continue improving our policies, our infrastructure.
Right now, after back-to-back contractions in 2023 and 2024, Lachica is hoping for a modest recovery this year. Sujin Kim, Bilyonaryo News Channel.
The president's SONA touched on agriculture, infrastructure, and social supports, but left the business community with more questions than answers. There was little on trade strategy, industrial policy, or a clear roadmap for growth. And with global tariffs, weaker exports, and easing interest rates, business leaders are looking for direction. They need signals they can act on and policies they can plan around. Joining us now to connect the dots is Security Bank's chief economist, Angelo Taningco, and he's also a former assistant secretary at the Department of Trade and Industry. He's going to help us make sense of these signals and the risks facing Philippine businesses. Hi, Angelo. Thanks for being here with us.
Thank you for having me, Maiki.
Angelo, as an economist and as a former DTI official, what stood out to you the most in the president's SONA? There was what was said and there was what wasn't said. What stood out the most?
Well, I think the theme of the SONA is geared towards social services, touching on the essentials that are basically important for Filipino households, such as food, water and electricity, transport, healthcare, and also infrastructure, among others. So, of course, the market is expecting, prior to the SONA, some discussion on recent developments pertaining to trade, and also on a sector-specific issue, such as in online gambling. But understandably, these two have been still ongoing on the tariffs still being negotiated by our government officials, and also on the online gaming side still being studied with the aim to generate taxes and also to regulate this industry.
Analysts were saying it was a politically safe SONA. That said, there's that 19% tariff. that 1% tariff cut, but we're still left with that 19% tariff, and it could squeeze Filipino exporters, dampen investor sentiment. The Philippines stands to lose 3 to 6 billion pesos a year under this zero-tariff deal with the United States. As an economist, what are your thoughts on this, and how might it affect us?
Well, the 19% tariff is comparable to our ASEAN peers. So we had 19% also for Indonesia and 20% for Vietnam, and still in the works for Thailand and the rest of ASEAN. So it's sort of uniform within the region. And in comparison, the Philippine economy is more domestic-oriented, since above 70% of our GDP comes from household consumption. And even if we combine exports and imports, their share would not be enough to offset household consumption. So we are relatively less adversely impacted by the tariff as opposed to the other peers in the region.
You mentioned uniform, but not exactly so uniform. While the tariff rates are relatively the same, the competitive landscape between Vietnam, the Philippines, Malaysia, Indonesia, between our ASEAN neighbors, it's not exactly the same. So going to GDP growth, I understand that you revised your economic targets last week ahead of the SONA in light of the tariffs from 5.9% GDP growth to 5.6% for the full year 2025. Doesn't seem like that much of a difference between 5.9 and 5.6. Can you tell us about what went on to merit the decrease?
As we learned about the 19% tariff, which is higher than the baseline of 10%, we decided to trim our GDP growth outlook for the second half of the year by only 20 basis points. And given that, with also our estimate for second quarter GDP pegged at 5.6%, we now have our full year growth forecast slightly lower from our previous estimate at 5.6%. So basically, this is largely driven by the higher tariffs that will be enforced second half of the year, and also certain headwinds still coming from the trade policy uncertainty that's worldwide, as well as the geopolitical risk. As now we have been seeing also a recent pickup in global oil prices again. I think it's up by 6% for 2 straight days already.
Yeah. On the one hand, inflation has been benign. Your targets for inflation unchanged at 1.9%. We get inflation data for July next week. Your expectations are for 1.2% despite the typhoons. Can you tell us about how you came around this figure?
The year-on-year 1.2% estimate is because of the high base effect coming from the same period last year. But on a month-on-month sequential basis, it has accelerated based on our estimate by 50 basis points coming from June. So it's still lower from previous months on a year-on-year basis, but potentially higher on a month-on-month basis.
Yeah, but still, your forecast of 1.2%, your house view of 1.2%, that gives the BSP so much more room to cut interest rates. BSP Governor Eli Romolona hinted at a rate cut. He said that was on the table this August, perhaps even another one in the fourth quarter. Is this in line with your own house view on monetary policy?
Indeed, we are still expecting another rate cut. But the timing of it, we think, even though Governor Remolona mentioned it's on the table in August, for us, we think that there is a need for the Fed to cut first before the local central bank can proceed with a third for the year in order to preserve the interest rates differential, which currently stands at 75 basis points. Or a historic low.
Yeah, razor thin interest rate differential. In this kind of macro environment, Jello, as an economist, what are you advising businesses to do? What is it? Is it the time to wait and see? Is it the time to expand? What are your thoughts given the current landscape?
Well, since the SONA has outlined several thrusts of the government for the next 12 months in terms of improving the budget utilization and also still prioritizing key areas such as infrastructure, I think the local business community can take response from that by continuing with its plans in order to take advantage of the still resilient domestic economy.
Yeah.
And therefore, because inflation is still benign, and that is our outlook for the remainder of the year, with policy rate cuts still ongoing, then borrowing costs will still go down. Market rates are likely to be driven lower, and there is also potentially more upside on capital markets such as the local stock market because of the lower discount rates, and hence the domestic-oriented nature of the Philippine economy will likely become more vibrant as opposed to the external global economic environment given the headwinds coming from the higher tariff. So no wonder even the growth outlook for next year is more upbeat. As in our case, we are still also looking at a faster growth for next year compared to this year in light of the aforementioned factors, benign inflation, lower rates, and also domestic resiliency.
So in a nutshell, Angelo, when you talk to your clients, as you do as an economist, what are you telling them?
Well, for those who are investing, of course, the advice is still stay invested, and at the same time, take a closer look at potential opportunities. For example, since we just had the recent reduction on the stock transaction tax from 60 bips to 10 bips, thanks to the CIMEPA, then that could be an opportunity for the stock market to improve. We have seen since the start of the month of July, higher trading volume activity, and therefore foreign investors are taking a closer look at the local bourse. And once foreign flows come in on a more sustainable basis, then that will provide more upside to
That's what we're really waiting for.
Local market. Yes.
Angelo, with the rate cuts on the table, what's your outlook for the peso? Because that's going to have a significant impact on how foreigners view the Philippines.
We are still seeing the dollar-peso exchange rate to settle at 57 by the end of the year, which is not much different.
57 flat.
Yes, from the current level, because there are offsetting factors to the widening trade deficit of the Philippines, and that mainly comes from the US dollar's inherent weakness, as investors are still not too upbeat on the dollar, given that higher tariffs. So that is offsetting the potential depreciation on the peso given the widening trade deficit.
So if you were to describe the state of the Philippine economy in this second half of the year, how would you describe it?
Well, it's still a business as usual, domestic economic performance, and given the macro backdrop already improving, then we could see a quickening of this domestic economic recovery moving forward over not just the next year, but also potentially in the medium term.
Okay, that's what we're looking forward to, a quickening recovery in the domestic market. Thank you for your time, Angelo, Chief Economist of Security Bank.
Thank you.
We're taking a short break. Business 360 will be right back. Welcome back. A constitutional showdown may be brewing at the House of Representatives. Pushes back against the Supreme Court's landmark ruling on the impeachment of Vice President Sara Duterte. On Bilyonaryo News Channel's On Point, House spokesperson attorney Princess Abante slammed the decision, claiming the High Court relied on erroneous facts when it declared the articles of impeachment unconstitutional. Abante says that the court sided with media reports over official documents from Congress and insists that the one-year bar rule was followed, since only the fourth complaint was considered formally initiated. She also criticized the country's new requirement for the respondent to be heard even after a vote from more than a third of the House members, which under the Constitution should have been enough to move the process to the Senate.
When we acted on the impeachment complaint, that requirement of due process was not part of the constitutional requirement. It was not part of the rules of the House on the initiation of impeachment complaints and the impeachment proceedings, nor was it a requirement under any of the previous Supreme Court rulings. So for the actions of the House to be declared unconstitutional based on something that was not a requirement by law at that time that the House acted on it, we need to assert that we did it constitutionally.
The House has until August 10th to file a motion for reconsideration, a move that could test the limits of judicial power and rewrite the rulebook on impeachment in the Philippines. Amid fresh accusations, the lower house says it's got one priority: passing laws, not playing politics. That's according to House spokesperson Princess Abante. After Senate President Chiz Escudero warned of a possible demolition job targeting him and suggested it may be coming from the House of Representatives.
We are focused on our job. The House's job is to advocate for and pass laws and not start any black propaganda against anyone.
Abante did not confirm or deny the claim, only saying she has no information on the matter and that the House remains focused on its legislative duties. While gridlock dominates the political arena in the private sector, it's a different story. Companies are shifting gears and driving forward. BMW is going full throttle in the Philippines with 2 new M-Series hybrids. And taking charge is a young executive and Bilyonaryo heir Jacob Ang of San Miguel Corporation. G. Baroga has more on the next-gen push for performance and electrification.
BMW Philippines, run by San Miguel Corporation of ultra-billionario Ramon Ang, is charging full speed ahead in its electrification journey. And taking the wheel on this one is RSA's youngest son, Jacob Ang, who's leading the charge on the ground. This time, BMW brought in the M5 sedan and the M5 Touring, 2 bold models packed with racing DNA and everyday luxury. This is BMW's 3rd plug-in hybrid launch this year. In an interview with BNC Mobility, Jacob shares his first impressions of the cars and what would make him choose each. For the M5 sedan, he says all the sportier aspects are evident.
So you can see all the carbon fiber around the car, the more aggressive colors, the more aggressive look. For me personally, if I wasn't playing golf, I would get this, 100%.
But for daily drives, Jacob's pick is the Touring. It's got space, comfort, and flexibility.
It's just more flexible. You know, I could have my friends with me. I could store more stuff at the back. The trunk space is so much bigger. I'm pretty sure the ride is probably also better.
BMW Group Asia Managing Director Lars Nilsson flew in for the launch and shares what makes M-Cars special.
We are taking regular cars and we are making them racetrack capable and at the same time capable of driving on an everyday basis.
Globally, BMW's M-Series is on a roll. Nilsson says M-Car sales jumped to 6.5% in the first half of the year, putting BMW at the top of the high-performance game worldwide. And the Philippines is catching on.
And I'm very, very happy to see how the San Miguel Group, how Jacob and Spencer and the team are making sure that M products are coming out to more Filipino customers, getting close to 2 digits in terms of share, as I'm hearing.
For BMW Philippines President Spencer Yu, it's all about giving Filipino drivers the power to choose, especially as more shift toward electric.
A good balance between between electrification and the traditional internal combustion engine. There are still, of course, those who are still really looking only for pure electric vehicle models, and we also have cars that cater to that, and they're also equally fantastic.
The new M5 and M5 Touring are now available across BMW dealerships nationwide, both priced at 12.79 million pesos.
Performance, luxury, cutting-edge tech, sleek design. These are the things that make the all-new M5 and M5 Touring truly a BMW. So if you are to choose, is it the sedan or this high-performance station wagon? For BNC Mobility, G. Baroga.
From hybrid cars to an urgent story overseas, a developing crisis involving Filipino seafarers in the Middle East. The Department of Migrant Workers confirms 9 Filipino crew members of the ill-fated MV Eternity Sea are being held by Houthi rebels. 3 others were reportedly dead, 1 still missing. DMW Secretary Hans Leo Kakdak reports that 8 of these seafarers have already been repatriated. Kakdak adds that they're coordinating with the Foreign Affairs Department on efforts to free the Filipinos still held by Houthi rebels. We're taking a quick break. Business 360 will be right back. Welcome back. The United Kingdom is laying down terms threatening to recognize a Palestinian state unless Israel ends the humanitarian crisis in Gaza and commits to lasting peace. Speaking at the UN headquarters, British Foreign Secretary David Lammy said the UK will formally recognize Palestine by September if Israel allows UN aid to flow back into Gaza and unless they commit to a 2-state solution.
His Majesty's government therefore intends to recognize the state of Palestine when the UN General Assembly gathers in September here in New York. We will do this unless the Israeli government acts to end the appalling situation in Gaza, ends its military campaign, and commits to a long, sustainable peace based on a 2-state solution.
Lammy said that the current situation is unsustainable and that recognition is a lever to press for peace. The UK joins a growing list of countries, including Spain, Norway, Ireland, and Slovenia, that have backed Palestinian statehood in the recent months. U.S. President Donald Trump says that the Wall Street Journal and its billionaire owner Rupert Murdoch want to settle the defamation lawsuit he filed against them. Trump sued the Journal and its owners over a story which said Trump's name was on a birthday greeting for late sex offender Jeffrey Epstein. The greeting included a sexually suggestive drawing and a reference to shared secrets. Trump's lawsuit called the alleged birthday greeting fake and said that the Journal published its article to harm his reputation. Murdoch's camp has yet to comment on the matter.
Can you say what the lawyers hope to get out of that?
Oh, I don't know. We're going to see. It's in the lawyers' hands. I've been treated very unfairly by the Wall Street Journal and everything. I mean, I don't know. They even hired people from the Washington Post, third-rate reporters, gossip-type reporters. It's all gossip. And, you know, I've been treated badly by the Wall Street Journal. I would have assumed that Rupert Murdoch controls it, but, you know, maybe does, maybe doesn't. They are talking to us about doing something, but we'll see what happens. Maybe they would like us to drop that. And so we'll see.
On another front, Chilean authorities crack a transnational theft ring recovering luxury watches stolen from Hollywood actor Keanu Reeves. The high-end timepieces worth hundreds of thousands of US dollars were stolen from Reeves's Los Angeles home back in 2023. They resurfaced in Chile during a wider investigation into a violent crime syndicate operating in Santiago. Chile's Attorney General formally turned over the stolen items to the FBI agents, marking a rare cross-border cooperation on luxury asset recovery. A 24-year-old suspect is now in custody and has been sentenced. The case underscores the rising threat to global luxury supply chains and the need for tighter international coordination against organized theft networks.
This was a process that started at the end of last year. We arrested a person from whom seized these items. Out of investigative work and an analysis that was done, we determined they belonged to actor Keanu Reeves, as they were robbed in 2023 in his country.
And that's it for Business 360. I'm Maiki Oreta. Thank you for joining us, and keep it here on BNC, the Bilyonaryo News Channel.